Dylan, what's up, man? Oh!
Yo, yo.
Oh, shit! Stop. What is going on?
Yes. What's good?
Oh, my God. John
guys? Coming from
Travolta
Austin,
joining
Texas.
us from Grease Lightning.
Yeah, down at Austin, Texas at a mining conference. So taking this one outside.
All right, let's get into Bitcoin. Obviously, Bitcoin went down a lot to start the year, December and January, pretty big price drawdowns. But now Bitcoin has come back. It didn't die, didn't go to zero. All the bears are wrong. They're stunned in disbelief. Let's start with just price weighted by hourly perps funding rate. Obviously, last week and the week before, you were talking a lot about the funding rates and kind of waiting for negative funding. What are you seeing now? What's this telling us?
Yeah, so I mean, we got it. We talk about derivatives a lot here, and really we like this graphic a lot to show kind of the bearishness or bullishness in the derivative market. So when there's negative funding, essentially what that means is that derivative bets, you have longs paying shorts, or I'm sorry, shorts paying longs. Okay, let me spit it out here. When this line is red, what you have is longs are being paid by shorts. So when you see kind of a short squeeze in Bitcoin, when Bitcoin's going vertical, oftentimes what's happening is in derivative markets, you have shorts that are being forced to become buyers, or they're actually being liquidated, margin called in the legacy system. That's what it's called. And so you have kind of that organic spot price, but oftentimes when you see these volatile moves at tops and at bottoms, oftentimes it's really the derivative markets that's driving the price action, and there's these forced unwinds that are happening. So we kept talking about, Will talks about it a lot, when we're going to get a regime of like negative funding. What that means is that you're getting times where your shorts are paying longs to enter a position. They're paying longs to sit in a derivative long position. And so we saw that at the bottom, and we saw as price was going up, funding was staying negative. So what that means was that perpetual swap price was under the spot market price. So whether it's on Binance or FTX perpetual swap or BitMEX, it was under, say, the price of Bitcoin on Coinbase. It was under a spot Bitcoin market price. And so that you can think of, like, I like this analogy a lot. When funding is negative, when you see that positioning under the spot price, it's like a beach ball underwater. And so it wasn't as significant as, say, March of 2020 or even this summer, but this kind of recent squeeze we've got, we've almost kind of vertical to 44,000 or around there. It's because of, the derivative bets that have started to really unwind. And so, that's what happens when bears get too bearish at the bottom.
Got it. And so if we look at the supply held by whales, that seems to be significantly changing, and they just seem to be gobbling up Bitcoin right now, holding as much of it as they possibly can.
Yeah, so we have here, basically the 30-day percentage change of whales and retail. And so with the blue pattern the blue color is when both of these cohorts are accumulating. And so you can kind of see, like, you can think of whales as like the smart money, and maybe they're not so smart just as much as they really can, change the market structure just with how much capital they have. So when you see both retail and whales accumulating, it's usually, somewhat of a bottom, or like it's a pretty good time to buy. And so recently we saw retail was continued to buy the entire drawdown. Whales were actually distributing, and recently that flipped. So both whales and retail are big buyers here, and we've seen that over the last month or so. And so I think that's a trend that's pretty good to see, and we'll see if it continues into the future.
Got it. And so then if we move and we look at actual retail entities and the whales, when you start to compare these over like the 30-day percent change, to me, what is a little bit hard to understand, maybe you can kind of help clarify this, is it doesn't seem like there's been that big of kind of delta or movement since maybe December or so. How do you look at this? And then if you look over kind of the last few years, what are you seeing here?
Yeah, so I think our slides were mixed. I changed it. So right now I'm looking at the supply held by only whale entities. So we're seeing that accumulation happen, and we saw that distribution at the basically the top of the bull market and into the downturn, and we saw that distribution kind of flip from November as that CPI print came in really hot, and Powell said, hey, we were wrong. Inflation's not transitory. And you saw somewhat of the smart money, like the big whales, start to distribute a little bit. So that's flipped in accumulation mode again. And really, like, these 30-day trends, it's interesting to monitor. But the reality is, for the most part, Bitcoin's always in an accumulation mode for most or a lot of market participants and new market participants. It's really just kind of incumbents, how much do they control and what are they doing? And so we're seeing that accumulation happen again, and rightfully so, with Bitcoin kind of down 50% from the all-time highs. Maybe not now. I think we're actually like 40%, 30% off the bottom. So quite a good bounce, but it's good to see that those whales, that traditional smart money crowd, step in big at the low 30K range.
Okay, and now this next chart I think is one of the most important ones in all of Bitcoin, which is the correlation between the Nasdaq and Bitcoin. And obviously, given all the Fed's interest rate comments and kind of the anticipation of them raising interest rates, Bitcoin's been treated up until the beginning of February as a risk asset. There's been a heavy correlation between Bitcoin and the Nasdaq, but it seems to decoupled now. What does this mean, and what are you seeing here?
Yeah, so that rolling 4-week correlation at 672 hour here. This is Nasdaq futures and Bitcoin. It got as high as like 0.94. Right now it's at 0.89. But if you're just looking at the chart, Bitcoin has quite a big pop. One of the days it was up, I think 10% when that short squeeze happened, and the Nasdaq was flattered, I think a little bit down in the day. So quite a decent decoupling. And I think we're not out of the woods yet in terms of the heavy correlation between Bitcoin and Nasdaq or Bitcoin and risk on assets. I mean, really, the reality is everything's kind of a function of the liquidity tide, whether that's pulling in or pulling out. And so I think really what you're seeing here is Bitcoin often decouples or bottoms first, or even forms a top first, right? If you're thinking about what happened in November, because of kind of the free market nature of Bitcoin and also the derivative market. It's the wild west, but that's the beauty of it. So Bitcoin bottoms, Bitcoin decouples because there's these derivative dislocations that resolve in big volatility moves to the upside or downside. And so recently everyone got over bearish. Macro sellers, I think basically it looked like they sold all of their coins, or for the most part they didn't have any more coins to sell. And those crypto natives, those Bitcoin natives stepped in and happily accumulated, and a short squeeze ensued. And so that's why we saw that recent decoupling. And so, we're going to monitor this relationship over the coming weeks, over the coming months, quarters, years. But I think it's a pretty positive sign to see that pop and kind of decoupling from the Nasdaq. And I can tell you one thing is that every risk manager worth their salt is looking at that relationship between those two.
Yeah, completely agree. And I think that it's a very good positive development and one to keep paying attention to. We've got a chart of the Treasury yields, and everything seems to be ticking up a little bit. What are you seeing here?
Yeah, so this is bond yields across the U.S. Treasury curve. We've been talking about bond market a lot, and really, inflation coming in at 7%. The entire curve is still, in real terms, deeply negative. But interestingly enough, you see the short end of that curve really bending upwards. And this is before the Fed has hiked whatsoever. So Powell said, all right, we're going to hike. But really, the market is telling him he's got to hike, or they're almost moving his hand without him actually doing anything. The curve is telling the Fed what it's going to do. And I think this has a couple different implications. Is one, yields and the principal value of bonds or really debt securities is an inverse relationship. So as yields go up, the principal value of these debt securities go down. And so especially on the long duration part of the curve, these 10-year, 20-year, 30-year bonds, as the yields are ticking up, they're getting killed in principal value. And I have a TLT chart. It's a long dated Treasury bond ETF later in the slide deck. But really the chart looks really, really ugly, not only in the Treasury market, but across all debt and credit markets. And so this basically we can kind of see that there's some pain being felt in these asset markets. And everyone likes to look at equity markets, myself included, but really credit markets tell a big picture. And what it's saying is that inflation, as well as I think the thing that's not very understood is kind of that solvency risk. It's starting to pick up a little bit, and I think we're seeing somewhat of a downturn in the credit cycle. And so it's going to be really interesting to see how it all plays out going forward.
All right, next we've got the U.S. oil price, and it's going up, baby. I remember at one point we got what was it? The futures in oil went negative in 2020, which is a pretty wild situation that I wrote quite a bit about at the time. But this is the actual oil price, almost like the spot oil price, if you will, and it continues to tick up. Why is this important?
Yeah, so I'm no expert in oil futures or these markets, but what I can say is that kind of paradoxically, as oil ticks higher, despite it, thinking maybe it's inflationary, it's actually rather deflationary over a kind of a medium term, because a higher oil price really impacts corporate margins as well as consumer spending. Oil, not only oil, gasoline, but really everything that's a byproduct of oil, which is like almost everything we touch and use in day-to-day life. As this ticks up, really, it's felt across the board for consumers, for retail, for corporate margins. And so if we see $100 oil, $150 oil, I've seen some pretty crazy price targets. It's going to get kind of crazy. And I think it's not good for a lot of things in the broader economy. A low oil price is better for the economy, that's for sure. And so, there's going to be a lot of pain points here if oil continues to rip. And I think it's something that everyone should, have on their trading view or on their dashboard.
Yeah, I think that's a great way to look at it. And then now we've got high yield bond ETF, JNK. What's going on here?
Yeah, so talking a lot about credit markets, it's not everyone's favorite topic here, but it's something to really watch. It's under the surface, right? Everybody likes to look at equity indices, Bitcoin, and I think over the long term, Bitcoin is kind of not isolated from all of these things, but it has its own monetization process. But over the short term, when you see things like junk bonds, the high yield credit markets, corporate bond markets really rolling over, it's a sign that something in the broader economy isn't too healthy. And so this is really telling a picture here that's the creditworthiness of a lot of these borrowers, and really what creditors are demanding in terms of yields, because as these prices fall in these bond markets, yields are going up. And the reality is creditors don't want to lend to junk borrowers at 4, 5, 6%, right? Because inflation is 7%. So before any default risk, you are negative real yields. And so it's basically a guarantee to lose money. And I think what people are starting to realize is inflation's not transitory. Why would I ever lend money at 5% when inflation's 7%, or inflation is whatever the reading is this next Thursday? And so it's a really interesting dynamic that's occurring here. And I think if we see junk bonds, if we see these corporate bonds really start to sell off in a big way, there's going to be liquidity and solvency problems across the broader economy. And I think that's something that, despite the recent bounce in equities, despite the VIX coming down from its high of like 38 over about 2 weeks ago, I don't think we're out of the woods yet. And I think it's going to be one of the bigger stories of 2022.
And then lastly, let's talk on the 20-year Treasury ETF. What do you see here with TLT?
Yeah, so this is just that when we were looking at the government bond yields, this is just the principal value. This is actually like the real value of those notes. So if you're just looking how far it's down from the 2020 high, even from the 2021 high, there's a lot of pain being felt here. There's tens of trillions of dollars. There's $30 trillion in government debt. Not all of that's 20-year long dated, but basically the value of every asset in the world is based on the value of these debt markets. And so when there's pain being felt here, there's knockoff effects in equities, and even Bitcoin to an extent is basically a function of what these markets are saying, what that cost of capital is based off of in these markets. And so if inflation continues to be persistently 7, 8, even 10%, if we start to get kind of crazy with these inflation prints, there's going to be a lot of pain felt in these debt markets. Equities are going to have a very hard time doing well. And I think over the short term, if there are any kind of macro allocators, I know there are people in the crypto, Bitcoin kind of world that don't even care about any of this and are just stacking regardless. But there are kind of broader effects on balance sheets and the broader macroeconomic landscape when debt markets are saying these things. And so all these things are rolling over. And I think it might be an opportunity for buying opportunity coming up.
Completely agree. Joe, John, what questions you got?
Dylan, I just want to know what the vibe is like down there in Austin. What are people saying at the conference? What are you guys talking about?
Yeah, a lot of big mining companies here, Riot, just across the board, a lot of publicly traded miners. So having really cool conversations. I can't lie, a lot of it goes over my head. I'm learning a ton, but it's exciting. There's a bunch of different kind of like innovative things I didn't even know were happening, immersion mining, all of this stuff. It feels like we're really on the cutting edge here. And I guess the vibe is that despite it, everybody feeling like, we're 12, 13 years into this, it's still really, really early. And a lot of oil and gas guys are here, and they're kind of blown away with what they're seeing from the mining side of things. So it gives me a lot of hope that, despite it feeling like we're really deep into this. It's still really, really early for most people in the world. And that's, that's obviously there's opportunity there.
It's a good sign.
Dylan, how do you view kind of the macro sense of things? We were comparing crypto adoption to the internet adoption earlier in the show. What are your thoughts around like that chart that's gone viral?
Yeah, I think, it's a pretty good comparison. I think it's, in terms of like users, every user in Bitcoin or crypto isn't comparable to say, the internet or, maybe like a cell phone adoption, because, one user's capital isn't equal to another. But in terms of just broader adoption, Bitcoin's not even $1 trillion asset. It obviously passed that threshold earlier, but there's, a few $100 trillion of monetary energy, as some people like to say out there. And so, Bitcoin's continuing to monetize. It's continuing to just serve as a black hole for capital. And I think that we're still probably in the second or third inning, maybe even not even that far. So very exciting, and obviously got a long way to go, but we're just starting to see things. I've heard some rumors actually of some pensions and some other big allocators over the past couple of weeks here starting to dip their toes. So we've been talking about it, but I think it's coming to fruition now. And that's obviously very exciting.
Glad to have a guy like you on the road for Bitcoin.
Appreciate it.
Dylan, last question for you is how much of the conversation there at the mining conference is about price versus hash rate or some of the underlying fundamentals and lead times of hardware, et cetera?
Yeah, obviously prices, it matters. But the reality is, I think anybody that has a decent source of power, and a lot of these are like contract negotiated, they're really, really deep in the money. The margins for a lot of these publicly traded miners are actually extremely wide. And so, price, even when it goes to 30K, like it's nothing but a thing for these miners. I think the real thing that's kind of shocking is that a lot of these lead times for stuff like generators, for ASICs, for rack space, it's crazy. Backed up for almost a year, maybe two out. I heard that a couple of publicly traded miners have 3, 4, 5, 6 exahash worth of miners. So like 2 to 3% of the entire network's hash rate currently just on pallets. So what that mean, they have the ASICs, they've already bought them, but they just don't have a place to plug them in. And so, everybody's scrambling to build out infrastructure to plug these things in. And it takes time. And so, obviously there's that's going to come and that's going to be built out. But, there's a lot of people working really hard on this, and especially in North America. So it's exciting for 2022 and beyond to see what comes of that.
Yeah, it's very interesting to kind of see that miners, to some degree, they're so in the money that price move is, it's not that they don't matter, but they're just so much less susceptible to them, whether it's 35,000, 43,000, 60,000, it's just all Bitcoin to them at that point. And if they can hold it, obviously that's pretty beneficial. And it feels like that's where a lot of them have ended up now, right?
Yeah. Did you see what happened with the Texas grid like last week?
Yeah. Explain real quick what happened with the miners in Texas.
Yeah. So Riot negotiated with the Texas grid ERCOT to basically buy power at a fixed price. But when there's kind of these times of excess demand from the grid, Riot agreed to sell that power back to the grid at actually a pretty high price because that demand is so high. And so Riot makes a lot of money mining Bitcoin, but when that Texas grid is really, really stressed, they happily shut off their machines and they sell that power back to the grid at actually a higher price than what they would get mining Bitcoin. So they win, the Texas energy grid wins, the people that actually need the power wins because their mining Bitcoin creates excess, demand for Bitcoin or for energy when no one else is using it. So overall, you see like people like the Texas governor championing Bitcoin mining as something that builds out a more robust grid. So this is something that's still very not well understood in mainstream circles, but it's increasingly become more of the mainstream conversation, and it's really, really encouraging to see that happen because just a couple of years ago it would have been unbelievable, and now it's just nothing but a thing.
Yeah, it's completely contrary to the public narrative of mining is bad. All of a sudden, people in those geographies, they're very happy that miners are there, right? They're thankful to some degree. And that doesn't mean that there's not more work to do, not more improvements to make, but definitely not the public narrative, I think, that is
Elizabeth Warren is in disbelief.
Yeah, she along with many people, which is pretty comical to me. But hey, they'll all figure it out eventually, my friend, as you already know. All right, let's do a quick follower check. How are we looking on followers for you? Where we at? Woo! Crossed 120, 500K by the end of the year. You think he's got
laughing? I don't think it's too
Dylan,
far out of range.
can I give you a suggestion on the Twitter
Shoot.
game? I think that you should get rid of your current profile picture and we should just like screenshot you just like this, and then you put that as your Twitter profile.
Screen grab it.
You are the only person that has successfully conducted an interview on this show with their sunglasses on the entire time, which I respect.
Got to be a first.
All right, buddy. Appreciate
Thanks,
you. We'll talk
Dylan.
next Tuesday.
Cheers, guys. Thanks.
Later.